The full title of this video should have been I invested in a company by mistake and now it is the worst performing stock in my portfolio. I invested in a company a few weeks ago. It was a mistake. And this company, this stock is already down 45%. It's not much of my portfolio, but I believe it's important to talk about it. Why did I invest in this company by mistake? What do I intend to do next? Because now it is underperforming. Does it mean that I'm going to buy more? Or maybe I should accept it that I made a loss and move on? Before we talk about all of that, please make sure to smash the like button for the YouTube algorithm. If you are new to the channel, my name is Ishfaaq. I am a popular investor on eToro, where I manage assets for 225 people. So please subscribe and hit the notification bell so that you don't miss the coming videos. I made a video a few months ago that I was going to invest in a bankrupt company. It is one of my best performing videos because on YouTube, not many people are going to make videos about investing in bankrupt companies. This is something that is about pure value investing, because you will see in Security Analysis of Benjamin Graham, he talks about this when a company goes bankrupt, the possibilities of what may happen and how you can profit from that if this is a value stock. So that's why I made a video about that. Usually, when a company is going bankrupt, there are three possibilities of what may happen. Number one, the company may be liquidated. If the company is liquidated, the first people who are going to be paid are the bondholders, and then eventually, if there is any asset left, the shareholders are going to be paid. But most of the time, this doesn't happen. The shareholders lose everything. The second scenario is that the company merges or is acquired by another company, or maybe it goes private. This is something that you can profit on. You can make money by arbitrage. And the third scenario of what may happen if a company goes bankrupt is that it comes out of bankruptcy after doing a debt restructuring. If the stock is at the right price and you already understand what the debt restructuring will be like, you already make the calculation and you find out that the stock now is cheaper, because once the company goes out of bankruptcy, it has a much better balance sheet, because most of the time it won't have any debt at all. So it is a much better company after bankruptcy. Of course, there are big risks whenever you are buying a stock which has gone bankrupt, because like I told you, the shareholders are not going to get most of the company. It's the bondholders who are going to get the equity of the company. So that's why it is risky, but at the right price, you can make an investment. So that's why at the time when I was making that video, the company that I had in mind was Whiting Petroleum. This company filed for bankruptcy in April this year. It is an oil and gas company. We know that oil prices crashed this year, and the company is losing money. It is an upstream company. The company is losing money. So that's why they will fail to meet their contractual obligations, and they decided to file for bankruptcy. But on that same day that they filed for bankruptcy, they already said how they were planning to come out of bankruptcy after 5 months. They already had a plan how to restructure their debt. They were going to convert most of the debt of the company to 97% of equity. In other words, the bondholders of the company, the creditors of the company, are going to gain control of 97% of the company. If you are a shareholder in that company, it is a bad thing for you, because let's say you used to own 10% of the company. After the debt restructuring, now you will own only 0.3%. So it is a bad deal for shareholders. But the stock price crashed, and like I told you, at the right price, it may be a good investment if you're a new shareholder. For the old shareholders, this is a bad deal, this is bad for them. But for the new one, maybe they can invest in the company, but only at the right price. And then we had a problem: Robinhood traders. The stock price of Whiting Petroleum gained over 1,000% in just 2 weeks. This is something very unusual for a bankrupt company. And it's not just this company. There have been Hertz, which gained more than 1,400%. We have seen companies, underperforming companies such as Kodak, gaining a lot during that period. It's not just Robinhood traders in general, day traders, who are trying to make a lot of money on those companies. And because those companies just went bankrupt, they have low market capitalizations. Only a small investment in those companies can push the stock price higher. For example, at some point, Whiting Petroleum had a market cap of only $30 million US dollars. So even if you invest, let's say $3 million US dollars, it's already 10% of the company. The stock price will go up by more than 10%. So you see, we have day traders trading with $3 million US dollars. These people just invest in that and they can push the stock price higher. And because of those people, I lost the opportunity of investing in Whiting Petroleum. The stock price went too high. It was not cheap enough for me to invest. But I set an order anyway. I said that if it crashes, because most probably it's going to be a pump and dump scenario, if it crashes, then maybe I can invest in the company. So I put an order at a certain price. I forgot about it because the stock price was still expensive. And then on that day that the company said that now they are coming out of bankruptcy, the stock price crashed. The stock price crashed and it hit that order that I set. And that's how I own now this company just as it came out of bankruptcy. It's a very little investment. It's only $50, but still I own the stock. So the next morning I was sleeping, of course, at the time when the company announced that it was coming out of bankruptcy. The next morning I wake up, I see that my order has been executed. I now own a few shares of Whiting Petroleum. I did not know yet the conditions of coming out of bankruptcy because they already made the conditions, initial conditions, but it may change. That's only when I was going to read about the report that they filed, how they are planning to come out of bankruptcy, what they are doing, what they are changing. For example, they changed the management, the CEO, and they were issuing warrants. So I read about all of that and I saw that maybe it's not such a bad deal. I would have preferred, of course, to buy it at a cheaper price. But now that I already own it, like Warren Buffett likes to say that if you have already lost your virginity, it's done now. You have already done it. He gave the example with Delta Airlines. He already reached 10% ownership of the company and he kept investing because he already reached that point. Now you can keep investing. So I had the same thing with Whiting Petroleum. And I decided to invest a little more as the price kept crashing. It's not a lot of my portfolio. It's only 0.3% of my portfolio. And it is the smallest position, of course. Why did I do that? Now that the company has come out of bankruptcy, like we said, most of the debt has been converted into equity. It has only $425 million US dollars in debt, in long-term debt. And I believe that they can produce enough cash flow, free cash flow, to repay that debt easily. Of course, there is a new management, a new CEO, new CFO. They have yet to prove themselves. Whenever there is a new management, that's not really a good idea to invest in a company, but at the price that it was, I believe that the risk is worth taking. And considering that now they don't have much debt, I believe that the company really, if the new management are more effective than the past management, then maybe it can grow at a faster rate. But there is something much more important which will determine the future stock price of this company, and it is oil prices. This is the main catalyst that move any oil stock, from the upstream one, the midstream, to the downstream oil companies. All of them are affected by oil prices. It doesn't matter really, because we know that upstream companies are more volatile, they are more affected by oil prices, but nevertheless, even the best, the most profitable of downstream companies, if oil prices go down, the stock price will go down. But it is less, they are less volatile. In the case of Whiting Petroleum, this is very volatile stock with such a low market capitalization. We can see the correlation between oil prices and the stock price of Whiting Petroleum. A small increase in oil prices can bring a big increase in the free cash flow of that company and consequently in the stock price of the company, because it is really undervalued. If you are going to value this company as you would value any other oil company, then it is very cheap. But we should not forget that it just came out of bankruptcy, they have a new management. We always need to take a margin of safety. And after I've taken all this margin of safety, it seems that it is still cheap. Even today, I will say that the stock is still cheap. But I'm not going to invest more because it's 0.3% of my portfolio. Let's say it becomes a 10-bagger. It can be 3% of my portfolio. I will take profit. I will be happy. But if it goes to zero, which is possible, it can go bankrupt again. It is possible. Then I only lose 0.3% of my portfolio. So that's why I think this is the amount of risk I want to put in that company. In the coming years, it is possible that we are going to have higher oil prices because demand is going to increase. Now we have low demand for oil. If demand increases, but still we have an oversupply of oil. So oil is something very risky, investing in all stocks and especially such a stock. But nevertheless, 0.3% of my portfolio, I believe, is not such a bad idea. And one more thing that we need to consider here is that the numbers on Google Finance or Yahoo Finance, even you look on white charts, these numbers are erroneous. The stock had a sort of reverse split when it came out of bankruptcy. And it seemed that this reverse split was not really accounted for on Yahoo Finance. Because in theory, it's not really a reverse split. Only in practice. In theory, here's what happened. The company came out of bankruptcy and they retired all their old shares and issued new shares, but under the same ticker symbol, WLL. So that's why you will see on Yahoo Finance, on Google, on white charts, they just made as if it's the same shares being traded, but that's actually not true. It's new shares. Because of that, it's erroneous if you're going to look at the market cap of the company and enterprise value of the company on Google or Yahoo Finance or even white charts. These numbers are erroneous. You need to look at the real numbers. On Yahoo Finance, it says that the company is worth 1.6 billion US dollars. But when I make the calculation, my calculator tells me that if, let's say, the stock price is $17 and we have 38 million shares, my calculator tells me that the stock is worth about 600 million US dollars. And the book value is 2 billion US dollars. So it means it is a bargain, it is trading under book value. To conclude, I will say that this is risky. It is the riskiest stock in my portfolio, but it is only 0.3%. And I believe that for the long term, I can hold on this, because if we are going to have higher prices, it can really be a good investment. But after that, we will need to see how the new management works on the company. If really they can change things, they can make things better, then maybe this will be a good stock to hold for the next decade. I don't know, but for the time being, we need to be careful. We need to keep following this stock. So let me know in the comments whether you ever invested in a company by mistake. Thank you for watching this video. Please like, subscribe and share. Please watch these two videos here if you have missed them. Have a nice day and goodbye.